As we look at Clem Corp and we look at how this company does over time, again, we're talking about why does the value of things go up and down. We got supply and demand, we have information, and we have performance. So Clem Corp at the end of year one, if you buy 100 shares of Clem Corp at $25 per share, your initial investment was $2,500. At the end of the year, Clem Corp has to provide financial information. We got to pay taxes, but we'll fill out financial statements. One of those being an income statement comparing our revenues to our expenses. And if Clem Corp breaks even, meaning its revenue coming in is about the same as its expenses going out, that's kind of they did okay, and it's probably not going to really move the share price of Clem Corp. Probably going to stay roughly the same at about $25 per share. Now, they didn't have a bad year, meaning the price would go down. They didn't have a really great year pushing the price up. As we look at stock value, the example I like to use is eBay. And it's a little bit of an outdated idea, but eBay is a service that links up buyers and sellers, and they're looking to trade, buy, or sell items. So you describe what item you're looking to buy, sell, or trade, and if you can find somebody who is willing to pay that same price for it, that transaction happens. It's kind of the same idea for stocks. So via supply and demand, via information, via performance, people are going to place a value on that company's shares. Clem Corp stock started at $25 per share. That was its initial public offering. Through supply, demand, performance, that'll push the price up and down. If there are people who have Clem Corp shares of stock at $25 a share, if they want to sell it, they need to go find somebody else who's willing to pay that same $25 per share. If they cannot find someone willing to buy it, the transaction doesn't happen. Prices will go up, prices will go down. If people are more interested in buying it than selling it, then the price will go up. If there's more people trying to sell it than buy it, then the price will go down. So again, the initial public offering for Clem Corp was $25 per share. We look at, is there anybody out there willing to buy it at the end of year two? Okay. Right now the price is still $25 per share because the performance didn't really push the price up or push the price down. So if there's no one really willing to buy it from you at $25 per share, you still own it. And again, that's kind of the risk of investing. We then move on to year two. And at the end of year two, Clem Corp makes a profit. And it seems to be doing pretty well. So the supply and demand, there's going to be more demand than supply of that stock, and it's going to push the price up. Okay, people are going to want the stock. The company is doing well. People want to own companies that are doing well. As that price goes up, here's a key idea and a couple of key questions. Okay, as the supply and demand changes, more demand than supply, what's going to happen to the share price? Well, it's going to go up. It's going to go from $25 up. How much up kind of depends on how bad other people want it. If the price of the shares go up or down, does Clem Corp get anything out of that deal? Do you get anything out of that deal? Once Clem Corp has sold its shares of stock after the initial public offering, Clem Corp doesn't really get anything out of that price going up or down. It's good for business to have, your share price go up, but if the price goes up, Clem Corp doesn't make any more money. In theory, you don't make any money either up until the point where you can sell that stock, again, like eBay. Now, if the price goes up, let's say it goes up from 25 to 35, if we don't have a buyer willing to pay you $35 per share for your claim in Clem Corp, the transaction doesn't happen. It doesn't matter how much it goes up. If there's nobody willing to buy it, you don't make any money. Now, yes, your asset or your investment got bigger. It went from a $2,500 investment to a $3,500 investment. Again, you own 100 shares at $25 a share. It went up to 100 shares at $35 a share. But until someone is willing to buy it from you, Nothing happens. Your asset got bigger, but you didn't, quote unquote, make any money. We did find someone willing to buy your shares of Clem Corp. You bought it at $25 per share, or you had an initial investment of $2,500. The selling price, again, the eBay idea, you found someone willing to buy it from you for $35 a share, so that's what you're selling it at. $35 a share, $3,500. For simplicity's sake, we're not going to get into commissions and things like that because you don't necessarily sell it yourself. Your investment person would buy it and sell it for you. More complicated than I need you to worry about. So did we make any money on that deal? When we sold the stock, we did. We sold it for $3,500. We had bought it for $2,500. We made $1,000 on that deal. So how did we do? Okay, well, the idea called rate of return is going to take any profit or loss, depending on if you lost money on the deal, and you're going to divide it by the initial investment. So the way the math works out for this one, we made $1,000 profit by owning Clem Corp. We had paid $2,500 to get Clem Corp. So 1,000 divided by 25 is 0.40, or a 40% rate of return. Now you compare that 40% rate of return in this example to maybe the 1% you would have got on your savings account, and owning Clem Corp looks like a great idea compared to putting that $2,500 into a savings account. The challenge is if things go sideways or if something goes wrong with Clem Corp, you don't only possibly not make any profit, you could lose that whole $2,500 investment. Okay, that could be gone. Company files bankruptcy, you get nothing back. FDIC insured savings account, you're going to get that $2,500 back. You're probably not going to get a ton of interest, but that money is FDIC insured safe. So we look at Clem Corp in year 3, and Clem Corp is just knocking it out of the park. They're doing great things again. Again, through supply and demand, information performance, it drives the price up to $45 per share. Again, nobody, quote unquote, makes anything until that product is actually sold. That share of stock is actually sold, and you can find someone willing to pay that price for it. Clem Corp is doing so well, they decide to pay some dividends. So as we look at how do people make money in owning stock, there's really one of two ways. One is you go ahead and buy that claim to the business, that share of stock, and the price goes up, and then you sell it. So in our last example, bought it for $25 per share, sold it for $35 per share. We made money on that deal. The second way you make money in owning stock is the company may give you a portion of the profits and they give it back to the owners. That's called a dividend. Now, corporations are not required to do that, but a lot of them do to keep their owners happy and owning the stock and keeping the stock price at a pretty stable number. The company's board of directors are the ones who can declare a dividend. They're the ones who can say, yes, we've made money and we're going to give away some of that money to the owners of the company. They will set a certain dollar value per share and say, we're going to go ahead and pay every single owner who owns a share of our stock 50 cents for every single share, or 25 cents, or $1, whatever the number happens to be. And in theory, the company would then cut a check to each one of the owners who own shares of stock and say, here you go, we did well. Here's a portion of our profit that the company made. Now, companies may say, we don't want to give away our profit. We want to keep our profit, make ourselves bigger, faster, stronger, buy more product, hire more employees, whatever that may be. But the board of the directors is the group that would decide if they're going to give away some of that profit in the form of a dividend.